What's up, everybody? The market is ripping higher. Have we hit the lows? I'm going to talk about that in this video. And I'm also going to go through a full portfolio review, all 7 companies I own in my portfolio. I'm going to talk about what their future returns might be based off analyst expectations and their current revenue multiple. So here's a look at the market. The Dow's up 1.5%, S&P 500 up 2%, and the NASDAQ is up 2.8%. Here's a look at the portfolio. We're almost at $53,000. We're up $2,900 today, almost $3,000 today for a gain of 6%. Let's be fully transparent though. If we look all time, which this portfolio started February 15th, we are still down $10,500. Let's cover all the positions. We have concentrated this portfolio down. I've put it into my best ideas that I think have the most growth potential. I'm comfortable with the risk of owning less companies and larger positions. I'm okay with that. Not a recommendation to anybody else. So I wanted to concentrate down into these best ideas that I think have tremendous growth ahead. I'm going to talk about exactly why. So we've got Snowflake, $8,300, Datadog, $8,000, Crowdstrike, $7,800, Gitlab, $5,900, The Trade Desk, $5,800, Tesla, $5,800, Cloudflare, $5,600, and RKLB, $5,500. This right here, what I'm covering is an email that my email newsletter subscribers got, austin.substack.com. First link in the description if you want access to this email. That's the benefit of being on the email list is you get these emails, you can keep them, you can refer back versus just kind of waiting for the videos to come out on YouTube. But you're welcome to just continue watching on YouTube. I obviously appreciate that. Our initial goal was to start with $10,000, my initial goal, and contribute $3,000 a month from 2022 to 2032 for a total contribution of $370,000. At that pace, I would have contributed roughly $19,000 by this point, but I've actually contributed $63,500 because I felt like the stocks that I liked had sold off so much and I wanted to get as much money into them as possible. It could be a totally wrong move, but that's just the way I did it. So we're $44,000 ahead of that investment schedule, which saving more money than you intended generally is not a bad thing if we can sustain it. So I'll share that along this channel transparently and just show you how I'm trying to build this portfolio up to $1 million. Has the market bottomed? Everybody's freaking out and all these doomsday headlines about inflation and commodities and gas going so high, a recession coming. All of that stuff is possible and things could get really bad. But I'm still of the opinion that this is a normal, healthy sell-off in the market. And so below, I've got a graph here. I'm going to explain it in a second. Is a chart of the S&P 500 from 2002 to 2018, which I consider a pretty normal time frame because it doesn't have COVID. The market ran up a lot in 2019, 2020, which kind of threw things off. There is a key on the right side, and you can see the adjusted earnings growth rate over that 16-year period was about 8% per year. The normal PE ratio was 16.8, represented by this blue line. So if you look at the fast facts box right here, the blended price to earnings ratio is 19.65. So I wouldn't be surprised if the broader index, the S&P 500, sells off another 10% or 20%. That wouldn't surprise me because of where we're sitting compared to historical norms. But I don't own the index. I own individual stocks. And I think the stocks I own, which I'm going to show in just a minute, their multiples and how compressed I think they are, I think they've sold off ahead of the S&P 500, ahead of the index, which is why I think there's a better opportunity there for me. One could definitely argue that we're entering a recession and earnings are going to disappoint. That's possible. Below is a chart that it shows an analyst expectations for the S&P 500 calendar year 22 and calendar year 23. They're expecting 1.4% earnings growth and 9% growth respectively. In the black box, I've shown the potential downside for the S&P 500 if the PE drops from 19.6 today down to 16.5 by the end of 22. You're looking at roughly 14% downside. So that is certainly possible, and it could get even worse. That's the broader market, and that's where I think the broader market's at. But let's talk about the stocks in my portfolio that I own. And again, there's a lot of chart here. If you want to see these, just check out the email newsletter so you can reference them and keep them. Snowflake, my top position, currently has an enterprise value of $35 billion. Their next 12 months, so how much revenue they're expected to have in the next 12 months, enterprise value to revenue has contracted from 58 in July of 2021 down to 16 today. And analysts are expecting revenues to grow 46% compounded annually for the next 5 years, from fiscal year 2023 to fiscal year 2027, which would leave them at $9.2 billion after fiscal year 27. If Snow hits $9.2 billion in fiscal year 2027 and has an enterprise value to revenue ratio of 10, down from 16 today, then the enterprise value would be $92 billion, a 162% increase from today's prices. That is a compound annual growth rate of roughly 21%. This is not a guarantee, so let's apply a 25% buffer to that on each side to get a range, which is how I look at stocks. I don't know precisely what's going to happen. Nobody does. If they say they do, ignore them and block them. In that case, the low would be an enterprise value of 69 billion and a high of 115 billion, which would give us a potential 5-year return of 97% on that low side to 228%. This could still be way off, but I think there's a decent probability that Snow has an enterprise value between 69 billion and 115 billion at the end of fiscal year 2027, which is calendar year 2026. I'm obviously bullish on the stock. It's my largest position. I think there's a strong chance that it ends up at the high side of that range, giving us that compound annual growth rate of 26%, which if you look at the market generally does 8 to 10% per year. If you could do that, you're fantastic, doing well. So 26% would be amazing. Because of their dominant results to date, excellent management team, and fortress balance sheet, I view it as having a relatively low risk of total failure. They've got something like $4 billion in cash or something like that. Snowflake reported their first quarter fiscal year 2023 earnings this week. I felt great about the slides, which I shared in a previous video, and the numbers that they reported. Very few companies are earning over $100 billion in revenue have ever grown as fast as Snowflake is growing. Management also updated their targets for fiscal year 2029. They left their revenue target at 10 billion, which I'll show below. I think that's actually a pretty conservative number. We'll see. But they increased their non-GAAP operating income margin from 10% previously to 20%. And they increased the non-GAAP adjusted free cash flow from 15% to 25%. So those are great signs that they're seeing proof of efficiency at scale. Real briefly, these were the Q1 highlights that they reported. 84% product revenue growth, 174% net revenue retention. That means that customers on average are spending 74% more 1 year after the other. They had 206 customers that were spending $1 million or more in product revenue, and they had 75% non-GAAP gross margin. Here are those fiscal year 2029 targets: 10 billion in revenue, 30% product growth rate at that time, and 78% gross profit margin, 20% operating income, and 25% free cash flow margin. So that's Snowflake. Getting the Datadog, we're going to go through these a little bit quicker. Enterprise value is $27 billion. Next 12 months EV to revenue has contracted from 33 in June of 2021 to 15.5 today, with 36% expected revenue CAGR, compound annual growth rate from fiscal year 2022 to fiscal year 2026. So we could see 32 EV to R in June of 2021 down to 15 today. And then here's their revenue CAGR. They're expected to grow 57%, 37%, 38, 38, and then 31%. That might be conservative as well. We'll see. So if Datadog has an enterprise value to revenue of 10 in fiscal year 2026, enterprise value would be 55 billion, up from 27 billion today, a return of 103%, which is a CAGR of 15%. In your mind, just apply that 25% buffer on either side. I'm not going to go through that for all of these because I want to speed through this a little bit and get you on with your weekend. Crowdstrike, enterprise value, $35 billion. Next 12-month EV to revenue has contracted from 38 in July 2021 to 16 today, with 33% expected revenue CAGR from fiscal year 23 to fiscal year 27. If Crowdstrike has an EV to revenue of 10 in fiscal year 2027, the enterprise value would be 66.5 billion, up from 35 billion today, a return of 90% and a CAGR of 13.7%. And just to give you an idea of how conservative these could be, if they have an EV to revenue of 15, then the total return would be 185% for a CAGR of 23%. So by having an EV to revenue of 15, which is kind of high, but possible, that CAGR improves a lot. And that could be the case with all of these stocks, or they could be lower. Who knows? But if the revenue can grow long enough, we'll be just fine anyways. The Trade Desk, $23 billion enterprise value. The enterprise value to revenue has dropped from 30 in June 2021 to 14 today, with 25% expected revenue CAGR from 22 to 26. At an EV to revenue of 10, the enterprise value would be $39 billion at the end of fiscal year 26, which is only a 70% return from here. That's a much lower return than other companies, but I'm comfortable owning the Trade Desk because it's clear that they are the established leader in demand-side programmatic advertising. They are already profitable, which is important for companies, and I believe that their industry and their position in the industry has such a long runway for growth that I'm okay having more limited upside in the short term, or the, out to fiscal year 2026 is 4 or 5 years from now, but still that's not a long time when you think about investing for 10, 20, 30 years. If they have outperformance for a longer period of time, then we'll do just fine, even though the 4 to 5 year return is not as good. Gitlab, enterprise value of $5 billion. So much smaller company, if you notice. Next 12 months EV to revenue has dropped from 27 on January 31st to 13 today, with 37% expected revenue CAGR from fiscal year 23 to fiscal year 26. At an EV to revenue of 10, the enterprise value would be $10 billion at the end of fiscal year 26, which is a 100% return and a CAGR of 19%. GitLab's 1/5 the size of other companies I've talked about, so much harder to accurately estimate for analysts. That means the results could end being far worse or far better than what they expect. I will cover GitLab in a future video and a future email, so subscribe to the email if you want to, subscribe to this channel, and do me a favor and like these videos if you find this valuable, because it helps more people find the channel. But anyways, this is just a snapshot from their last quarter, just to give you an idea of the business. So they run everything on one seamless platform for their customers. They've got 4,593 base customers, 492 customers that spend $100,000 or more on their platform. 100% remote since inception. That's just their business model, the way they treat their employees. They have $311 million in revenue run rate annually, 69% year-over-year revenue growth in their most recent quarter, 152% dollar-based net expansion rate or net retention rate, which means, again, that's how much more customers are spending each year. 120% is pretty good. 130% is really good. 150% is amazing. And if you remember, Snowflake 172, 174% is like unheard of. 89% non-GAAP gross margin. So if you're familiar with GitLab, there's a lot of fear that Microsoft's GitHub could threaten their model. But essentially, even if Microsoft GitHub takes 60% of the market and GitLab is only left with 40% market share, which is kind of what this expert that was a previous executive leader at GitLab. Even if that happens, GitLab would be just fine because the market is so big. So even if it's a first place, second place thing and GitLab's in second place, they'll still do just fine over time. Tesla, if you've probably never heard of this company before, enterprise value of $723 billion. Next 12 months EV to revenue has dropped from 12 on June 30th, 2021 to 7.6 today, with expected revenue CAGR of 23% from fiscal year 22 to fiscal year 26. Next 12 months EV to EBITDA has dropped from 65 in June of 2021 to 31 today, with an EBITDA CAGR of 24% from FY22 to FY26. Have no idea what lines of revenue Tesla's going to have in FY26. If I had to guess, I would think they have more lines of revenue in the future than they have now. Hard to imagine $200 billion in revenue, but it's been done before by companies like Google, Apple, Amazon, so it's possible. At an enterprise value of revenue of 7 at the end of FY26, Tesla's enterprise value would be 1.38 trillion, up from 723 billion today, a gain of roughly 90%. At an EV to EBITDA of 20 at the end of FY26, Tesla's enterprise value would be just over 1 trillion, which is only a 40% increase from here. These returns are not impressive compared to those other companies, but if there's any company that's being underestimated, it's probably Tesla. And so the upside could be gigantic. It could also be the most overestimated company, and that's a risk we have to be willing to take if we own a large position in Tesla, which I do. It's about 10% of the portfolio. The bottom line is no matter how bullish you are on the stock, Tesla is risky. The upside is there, but it's a risky stock. Cloudflare, we're getting to the end here. Stick with me. Cloudflare, because you want to see Rocket Lab. Rocket Lab's a tiny little one with a lot of potential upside, and we're going to cover that one last. Enterprise value, $18 billion in Cloudflare. Next 12 months, EV to revenue has dropped from 49, which is just ridiculous, in June of 2021 to 17.5 today. Expected revenue CAGR of 47% from FY22 to FY26. These estimates are from Ticker, which gets their data from S&P Global Capital IQ, which is a very respectable service. But that 80% growth expectation in fiscal year 25, they're expecting revenue to grow by 80%, isn't accurate. That's just, it got mixed up there with the way they pull this data. So I'm going to use an FY26 EV to revenue multiple of 7 instead of 10 to be even more conservative. At an EV to revenue of 7 in FY26, the enterprise value would be $31.92 billion, up from $18 billion today, for a total return of 77%. That would only give investors a 12% CAGR, but remember the market on average does between 8 and 10%, so still would be beating the market. That's not super impressive, but given their current size, remember it's a smaller company, and the estimated total addressable market, I'm comfortable with that for now because again, that upside could be, have a long time out. And this is just a slide from their recent investor day, but they're saying that their innovation drives massive TAM expansion. So if you look today, they estimate, this is the company estimating it, so obviously it's biased, but still, they estimate $115 billion in total addressable market. By FY24, they're estimating that grows by 20 billion to 135 billion. And so just there alone shows what the growth could be in their market size and how much runway could be left ahead, which is why I'm okay with, a little bit less of a return over the shorter term. Here is their longer term model. They don't provide a revenue target like Snowflake did, but they do provide a long-term, they provide gross margins estimates. They estimate in their long-term model for gross margins to be between 75 and 77%. And they think the non-GAAP operating margin will be 20% plus, up from 2% plus today. So they believe the business is going to get significantly more efficient over time, which is what we want to see. We want these companies to eventually be profitable. We want them to invest for growth now, which is why we're okay with them not being profitable, but they've got to show signs in the ability to get profitable. So Rocket Lab, enterprise value of $1.7 billion, easily the riskiest stock that I own, could very easily end up as a big giant zero. So owning a stock like this, especially as a large position, which it's like 10, 11% for me, is not for everybody. However, I know myself, I know that I'm comfortable with that risk and that volatility. I also believe Rocket Lab has the potential to have the largest upside because it's got a 1.7 billion current enterprise value and the expected growth of its market, the space market. Rocket Lab's enterprise value to revenue has dropped from 65 on September 30th, 2021 to 7.4 today. What a drop. With 56% expected revenue CAGR from FY22 to FY26. Nobody on earth has any idea, get it on earth, it's a rocket company, has any idea what their revenue is going to be in FY26. So there's that, remember that. But let's just go with it for the purpose of this exercise. At an enterprise value to revenue of 5, which again is half of the 10 that I've been using for those SaaS or software companies in FY26, the enterprise value would be 6.2 billion, up from 1.7 billion today, a 265% return, which is roughly a 30% CAGR. That number's way off. That revenue number is going to be way off. It's just, I don't have any idea if it's way low or way high.